Today we're talking about Chapter 10, Section 2, and income tax. So you remember, I say remember, but you know how people say, man, I wish they taught us something that we actually used in the real world. Well, we will continue that with this particular course, and my I again I really like this course. Obviously, you guys are taking tests, and our opinions may differ, but it's a good class. And income tax is very important. Furthermore, it's actually pretty darn spot on. Like some of the word problems that we do are pretty much you know. Like I mean, we don't none of us are riding one train going one way and a train going the other. Not too often, anyways. And even if we are, we're not trying to calculate anything. But income tax is definitely something that we do. Now, unfortunately, there's going to be a lot of reading, and I haven't quite figured out how I should do this. So I'm just going to do it. Anyways, this first part's pretty funny about The Simpsons, I think. Give that a gander whenever you have the time. But we won't today, or I won't in lecture anyways. Um, which is funny, back in 1996, when I was in fourth grade, um, I remember I remember getting a magazine, and it was just a magazine that we got in class, and it was talking about how The Simpsons have been on for 200 episodes, and that was such a big deal back in 1996. And I believe they're still going strong now, which is pretty crazy. All right. And unfortunately, I am going to have to. There's no other way around it. It's just the way this is set up. I am just gonna have to read this. I mean, yes, I can gloss over some of the bold areas and stuff and read that, but there's a lot of good information in here, such as I know in a later example we talk about medical expenses, and so it's just gonna be one of those days, guys. And I'm sorry if you're obviously watching a recording of this, you can fast forward this to whenever, but it shouldn't take any longer than 2 or 3 minutes for me to read through it. Follow along, whatever, but here we go. Paying income tax. So income tax is a percentage of your income collected by the government to fund its service and programs. The federal government collects income tax, and most, but not all, state governments do too. Alaska, Florida, Nevada, South Dakota, Texas, Washington, Wyoming have no state income tax, and I'm pretty sure Tennessee doesn't either. Tax revenue pays for our national defense, fire and police protection, road construction, schools, libraries, and parks. Without taxes, the government would not be able to conduct medical research, provide medical care for the elderly, or send astronauts into space, or pay our politicians to do whack jobs. But anyways, income tax is automatically withheld from your paychecks by your employer. The precise amount withheld for federal income tax depends on how you fill out your W-4 forms which you complete when you start your new job. Although the U.S. Congress determines federal tax laws, the Internal Revenue Service is the government body that enforces the laws and collects taxes. The IRS is a branch of the Treasury Department. I have such a disdain for paying taxes, and I'm sure many of you do too. If you don't already, you will later on in life. Determining taxable income. So now this is where the bold. I feel like I could have just went by and read the bold, but I really feel like a lot of context is also needed. And if I go over it and especially highlight some of the areas, the at least the first two examples will go by a lot smoother. So federal income taxes are a percentage of your taxable income, which is based on your earnings in the calendar year from January to December. When the year is over, you have until April 15th to file your tax returns, which, by the way, don't tell the IRS you need an extension. Good luck with that. Calculating your federal income tax begins with gross income, or total income for the year. This includes income from wages, tips, interest, or dividends from investments, unemployment compensation, profits from a business, rental income, and even game show winnings. It does not matter whether these winnings are in cash or in the form of items such as cars or vacations. Right? Cars or vacations, they have a value attached to them, and they will be going to your gross income. The next step is calculating your federal income tax is to determine your adjusted gross income. So your adjusted gross income is figured by taking the gross income and subtracting certain allowable amounts called adjustments. And we'll talk about adjustments here in a moment. You are allowed a certain adjustment based upon your filing status. These untaxed portions of gross income include contributions to certain retirement accounts and tax-deferred savings plans, interest paid on student loans, and alimony payments. In a traditional tax-deferred retirement plan, you get to deduct the full amount of your contribution from your gross income. You pay taxes on the money later when you withdraw it at retirement. So, Adjusted gross income, and I'm gonna re-snip these two sandy boxes whenever we get to the example because they're very important. So the adjusted gross income is your gross income minus the adjustment. And again, I'll tell you about the adjustment here in a moment. The IRS rules detail exactly what can be subtracted from gross income to determine your adjusted gross income. Here we go. You're entitled to certain exemptions and deductions. So this is taken away from your income. So basically what happens is let's say you earn $100,000. You get exemptions and deductions. So instead of being taxed at a $100,000 rate, you can get taxed at like an $80,000 rate or a $70,000 rate. That's what these do. Before calculating your taxes, an exemption is a fixed amount on your return for each person supported by your income. You're entitled to this fixed amount. It's $4,050 in 2016, and I think it's for a single, obviously for a single filer. For yourself, and the same amount for each dependent. So a standard deduction is a lump sum amount that you can subtract from your adjusted gross income. The IRS sets this amount. Most young people take the standard deduction because their financial situations are relatively simple and they are not eligible for numerous deductions associated with owning a home or making charitable contributions. Now, itemized deductions go in the same category as standard deductions, but you pick only one of the two. Now, again, this is the crashest of courses on income taxes, but it's actually pretty good. Um, Itemized deductions are deductions you list separately if you have incurred a large number of deductible expenses. Itemized deductions include interest on home mortgages, state income taxes, property taxes, charitable contributions, and medical expenses exceeding 7.5% of adjusted gross income. Taxpayers should choose the greater of a standard deduction or an itemized deduction. So taxable income is figured by subtracting exemptions and deductions from adjusted gross income. Whew, that is a lot more than I thought it would be. Okay, so taxable income is the adjusted gross income, which we have over here, and then minus the total of exemptions and deductions. So before we actually begin this, I think this chart over here. Let's see. I think this chart right here really helps to visualize exactly what we're looking at. Okay, and again, this is for this example 2, but it's pretty good. So when you're doing your taxes, obviously, I mean, this day and age, you could do TurboTax and things like that. But way back in like the mid 2000s, when I was working and I did my own taxes, I had to look at a chart like this. So you just basically say, okay, so where am I at? Right? And was I single? Am I married, filing separately? Married, filing jointly, or head of household? I was single. And of course, it depends on where you're at here. But depending on what your income is, okay, let's back then I think I might have made like $15,000. So I was right here in this area here. I got a standard deduction of $6,300 because I was filing as single, and I also had an exemption of $40.50. Now the exemption is different than the standard deduction, obviously, but the standard deduction is it goes in the same realm as your itemized deduction. And as a tax filer, you pick the greater of the two. But anyways, I taxed myself 10% up to $92.75, and then 15% from $92.75 to $15,000. And that's how that operated. And again, I mean, we're only 8 minutes in, and I feel like I've covered a lot. So let's just go ahead and get to the example, so that can maybe help us out a little bit more. So I got to go back. I'm going to snip the adjusted gross income and stuff like so we can follow along with that. Alrighty, let's begin example 1. So, a single man earned wages of $46,500. He received $1,850 in interest from a savings account and received $15,000 in winnings on a television game show and contributed $2,300 to a tax-deferred saving plan. He is entitled to a personal exemption of $4,050 and a standard deduction of $6,300. So he is entitled to this exemption and standard deduction. Now, the interest on his home mortgage was $6,500. He paid $2,100 in property and $1,855 in state, and he contributed $3,000 in charity. So when we talk about between standardized deduction and itemized deduction, you're going to take the larger of the two, and we'll see what I mean by that here in a moment. Okay, so maybe I should have snipped the the actual questions there. Here we go, next page. Alrighty, so we need to determine the man's gross income. All right, looking up here, the uh, uh, the gross income. Okay, so we don't have the adjusted. Okay, well the gross income is just everything that he possibly could have had that that was considered that has some sort of monetary value. And in the problem, we see that he earned 46,500. He received 1850 in interest, and he received $15,000 in game show in winnings on a television game show, and he contributed 2,300 to a tax deferred savings plan. Okay, so contributing 2,300 doesn't correlate into a gross income. Just those first three numbers do. You know, his wages, his interest earned, and his winnings in a television game show. So you would say his salary is 46,500 plus 1,850 from the interest on his savings account plus 15,000 on a game show host, not host, but game show. So all that together is $63,350. So 63,350. All right. Now we have to determine the man's adjusted gross income. So the adjusted gross income, looking here, we need to adjust the gross income is the gross income minus the adjustments. All right. Well, in this particular case, his only adjustment is a contribution to a $2,300 tax deferred savings plan. Now this is why I went and read the entirety of all this, because in here we talk about adjustments. These untaxed portions of gross income include contributions to certain retirement accounts and tax deferred savings plans. So you honestly would not have seen it if you didn't read all this. Not only that, but I mean, I knew it was there because I remember seeing it. But if you're the student, you know, you have all your classes, you might be working a part-time job, kids, friends, you might have glossed over it and missed it. And so, again, that's why I read it. But yeah, the tax deferred savings plan does count as an adjustment. So if we go back up here, it's gross income minus the adjustment. Well, this is a pretty easy formula here. The gross income was 63,350. So 63,350 minus my adjustment of 2,300. Right, and that is equal to, we could do this in our head, right? 60, 150. Okay, so that's the adjusted gross income. Now we have to talk about the taxable income, and this is where looking at that chart I gave you a second ago maybe kind of helps. I don't know, but we'll see. So we're going to look at the taxable income. So the taxable income is the adjusted gross income, which is our number here, minus exemptions plus deductions. Okay, so we are going to be looking at the exemption. So we are entitled to a personal exemption of 40. Where is it at? There it is. He is entitled rather, to a personal exemption of 4,050 and a standard deduction of 6,300. Now, the way this works is we could go one of two ways here. Okay, and if I were a very lazy tax accountant, I would say, okay, so your adjusted gross income was $61,050. Okay, and again, I'm going to follow this equation here, and we're going to subtract Your exemption is 4050 because you are a single taxpayer. That's your exemption. All right, and then plus your deduction. So we're just gonna take your deduction that you are entitled to, which is 6,300. 6,300. And if I did that, then that comes out to 61,050 minus 4050 plus 6,300. That means his taxable income will be $50,700. Okay. Now keep that in mind, and I'm actually going to put that up here so I can just keep it as a note. And obviously, the more you make, the more taxes you have to pay. So if I was again a lazy tax accountant, and I said, okay, we're just going to take your standard deduction and just roll with it. Okay, and he's like, okay, fine, and you pay tax on 50,700. Okay, but let's say that I'm not a lazy tax accountant, and I say, okay, so you're entitled to a $6,300 deduction. All right, and let's go back to our notes here. Talking about deduction. So let's just go ahead and reread this real quickly. So a standard deduction is a lump sum amount that you can subtract from your adjusted gross income. The IRS sets this amount. Most young people take the standard deduction because their financial situations are relatively simple and they are not eligible for numerous deductions associated with owning a home or making charitable contributions. I take a standard deduction. I don't own a home. I don't pay mortgage. I don't do interest here, nothing like that. However, you could pick either standard deduction or an itemized deduction. Now, itemized deductions are deductions you list separately if you have incurred a large number of deductible expenses. Itemized deductions include interest on home mortgages, state income tax, property tax, charitable contributions, and medical expenses exceeding 7.5%. So let's go back here. And this fella, the interest on his home mortgage is 6,500. So let's put this down here in yellow. 6,500 is his interest on home mortgage. He paid 2,100 in property tax. Again, these are problems that I don't have, so I just do standard deduction. 1,855 in state taxes, so plus 1,855, and contributed 3,000 to charity, so plus 3,000 to charity. So all this adds up to, I mean, the interest on his home mortgage already is more than the standard deduction. So that's the route we would obviously want to go, but all this together is 10,755. 65. That doesn't make sense. Oh, put one more zero there, Sherman. 13,455. 10,455. Okay, so again, this number is a lot larger than this number. And I'm going to choose the larger of the two because I want to pay as little tax as possible. So I'm going to not do 6,300 and instead use 13,455. And now my new total here, my new taxable income will be 61,050 minus 4050 plus 13,455. So my new taxable income is going to be 43,545. Okay, and hopefully you're following along so far, but this is the taxable income I want. I don't want 50,700 to be my taxable income because the more money that I make, the more money I'm going to be taxed on. And while I did earn, all that money and have all that stuff, I am entitled to choosing either standard deduction or itemized deduction. And you want to choose whichever one is greater because you want that number to be subtracted from your adjusted gross income. So my taxable income is going to be 43,545. And hopefully, I feel like I did all right there. I felt comfortable with that. Okay, next up, federal income tax. Let's see. this next problem isn't too much different from the first two, and unlike, actually I say unlike, but I'm pretty sure it's this class always. But the first two examples are actually the harder ones for this section, anyways. Okay. Don't know if I'm gonna have room for this. I'll make room. I'm also going to have to reference this chart for example 2. Oh, we have room. Okay. Alrighty, so this I can just kind of look for highlights here. So the way this works is calculating federal income tax is basically what we did in the first example, except now we're going to be looking at our tax bracket. These are our tax brackets. All right, and again, this is the chart that I showed earlier. Not much different. It's just we're looking at tax bracket and the tax rate at each individual bracket, and this is as of 2016. Okay, so with that said, I don't actually think there's much to it. Um, let's begin this and see. So alrighty. So calculate the federal income tax owed by a single woman with no dependents, whose gross income, adjustments, deductions, and credits are given in the margin. Use the 2016 marginal tax rates. All right, so we have to use the marginal tax rates, which are given in the, maybe I can put that. Let's see if we can't snip this chart for a third time. That way I don't have to go back and forth, especially if you do actually look at the notes. We'll put it up here, maybe make it a little smaller. Okay, so it's nice and super small. But I've rewatched these lectures. These lectures are in high def, so you can actually see those. Um, so anyways, our single woman with no dependents, gross income, adjustments, deduction, and credits are given in the margin. So use the 2016 marginal tax rate. And is there a, I mean, we obviously want to know something here, don't we? What are we trying to find out? Okay, so I guess we're just trying to figure out the income tax owed. Yeah, okay. So first thing we need to do is we need to figure out the adjusted gross income. And then we do the taxable income and then we tax. Okay. So the adjusted gross income is going to be she makes $62,000 and so we'll do this. We'll do adjusted. As a matter of fact, AGI is the acronym used by the IRS. So the adjusted gross income. We can do this pretty darn quickly in our heads here, right? She makes 62. Her adjustment's 4,000, so it's $58,000. $58,000 is her adjusted gross income. Okay. Next up, we need to figure out the taxable income. Now, the taxable income is the adjusted gross income minus the sum of exceptions and deductions. So let's figure out what exceptions and deductions are. Okay, so she is single, so she's automatically going to be getting, did I say exceptions? I meant exemptions. She's going to be getting $4,050 in exemptions because she is single. Okay, so, well, actually, that's all of them, huh? Well, she gets $40,050 because for living and breathing, I guess. So that's her exemption, and her deductions. Again, she is entitled to $6,300, just like the guy in example 1. But looking right here, she's already paying $7,500 in mortgage interest, which is greater than $6,300 in standard deduction. So I'm gonna be itemizing. Okay, so let's itemize this, and so it's $7,500 in mortgage interest plus 2,200 in property tax plus 2,400 in charitable contributions and plus 1,500 in medical expenses. But wait a minute. I remember reading something about medical expenses earlier. So let's go back and read the text that I painfully read earlier. And right here it reads, charitable contributions and medical expenses. So under itemized deductions, we can use medical expenses, but only if they exceed 7.5% of adjusted gross income. Okay, so let's go back. And 7.5% of adjusted gross income, real fast. So if my adjusted gross income is 58,000, what is 7.5% of 58,000? So times 0.075 is 4,350. So my medical expenses have to exceed 4,350 for me to be able to use them in my itemized deduction. Well, 1,500 is not greater than 4,350, so we cannot use that as a deduction. Okay, so there's that. So all these together add up to 7,500 plus 2,200 plus 2,400 is 12,100. 12,100. And again, I want to use the higher number. So I'm going to use the higher number of 12,100 or the standard deduction allowed to me, which is 6,300. I'm going to use 12,100 because it is obviously a larger number. Okay, so following my formula, I know that I have my AGI, my adjusted gross income, of $58,000, and then I'm going to subtract the sum of my exemption, which is 4050, plus my itemized deduction, which is 12,100, and I'm going to end up with $41,850. Okay, so 41,850, but we also get a tax credit of $500. But we're not going to touch that just yet because that's a tax credit that I'm going to add on to the very end. Okay, so let's see, my taxable income right now. Taxable, might as well just, that's stupid. We'll just do, yeah, we'll write it in print. How about that? Taxable. My taxable income is 41,850. Okay. So from this, how can I figure out how much taxes I owe? Well, we're going to look at our tax bracket. We make 41,850. We look at I'm single. I make between 37,651 and 91,150. So I'm in the 25% tax bracket. Okay, but that doesn't mean all of it that doesn't mean I'm losing 25% of 41,850. That just means anything over 37,651 is taxed at 25%. So how do we do this math? Okay, so the way we go about this is we say, okay, the first 9,000, again I'm looking here, the first $9,275 is taxed at 10%. So I'm going to say 9,275 times 0.1. Okay, so that's taxed at 10%. That's how that's written. Plus, all right, now the next bit is going to be taxed at 15%. So the amount of money between 37,650 and 92.75. So we say, I'm just going to do the calculator for that because I see I'm going to run out of room. So 37,650 minus 92.75 is 28,375. 28,375, and this is taxed at 15%, 0.15. And then lastly, the little bit of income above 37,000. Okay, I'm making she's making 41,850. That $4,000 and some change is being taxed at 25%. So the entire thing's not taxed at 25%. Just that bit that's above 37,000. So, that math is 41,850 minus 37,651. So 41.99. So plus 41.99, and that is being taxed at an incredible rate of 25%. Now, we're going to put this into our calculator and we're going to see how much taxes we owe. So 9275 times 0.1 plus 28,375 times 0.15 plus 4199 times 0.25. So we owe $6,233. Did it say something about to nearest dollar, or is that another problem? Maybe it was another problem. But $6,233. Okay. But again, now we have our tax credit here of 500, and that's where that comes in. So we're going to take that and subtract from our amount here. And so my new tax I owe is 6233 minus 500, 5733. So 733. So this lady, she makes $62,000, and from her mortgage interest, property tax, all that stuff, she owes $5,700 in interest. I'm sorry, in taxes. And so you see the importance of wanting to itemize your income as low as possible. Remember, I said, we could take the standard deduction, or we could do the itemized deduction and reduce it more, right? Well, we reduced we reduced it by $6,000 more than it would have been. So what we had 41, so 48,000. So we'd be paying an extra 7,000 more at 25% tax. So that's why itemized deduction, obviously if it's available to you, and of course there's more to it than just mortgage, property, and charity and stuff like that. But for me, I live a pretty simple life. I'm probably going to be doing standard deduction for a long, long time, if not the rest of my life. But if I ever do own a house and things like that, I would definitely be going into the itemized deduction because I can reduce so much more from my income to be taxed. And I believe that was it for that. Whew. Okay. Now, example 3 and 4. They went to change. Oh well. The next two examples are so easy that it makes my soul happy. Okay, so Social Security and and Medicare. So, in addition to income taxes, we are required to pay the federal government FICA, Federal Insurance Contribution Act taxes that are used for Social Security and Medicare benefits. So, Social Security provides payment to eligible retirees, people with health problems, eligible dependents of deceased persons, and disabled citizens. Medicare provides health care coverage mostly to Americans 65 and older. So, similar to our tax bracket that we saw on the previous page, well, actually, the thing I snipped 3 times, we have a FICA kind of tax bracket, right? And we have the employee's rate, the matching rate paid by the employer, and the self-employed rate. So taxpayers are not permitted to subtract adjustments, exemptions, or deductions when determining FICA taxes. So there is no exemptions. There's just you pay this percent on this amount of money. And lucky for us, because I don't know about you guys, but example 2 kind of fried my brain. So example 3, if you are not self-employed, so that's going to tell me that I'm going into the first bracket here. Again, this is for the employer and this is for the self-employed. So the employer has to match, as you can see. But anyways, if you're not self-employed and earn $150,000, what are your FICA taxes? So it's going to be 7.65% on the first $118,000, and then 1.45% on anything above 118,000. Well, I earn 150,000. So how do I do this? Well, the same way I did the previous one. So I'm going to say on the first $118,500, I'm going to pay 0.07765 percent, right? And everything over $118,000, and if I make $150,000, then that would be 31,500. So plus 31,500 is being taxed at a rate of 0.0145. And that's awful. Let's see. Can't, there we go. And put parentheses there. All right, hang on, let me fix this. I'm going to make this just a little bit smaller so I don't have a crayon parentheses in there. There. Oh no, what happened? Oh no. What? What's going on? There we go. Sorry. All right, now I'm just going to do this calculation. So 118,500 times 0.0765 plus 31,500 times 0.0145, so 9522. So we are supposed to pay $9,500 in FICA taxes if we make $150,000. And that was pretty easy. That was good. That was easy. And then the last one is also pretty easy. I mean, we go to F, but it's pretty easy. And it really kind of hits home just where in the world your paycheck goes. All right, so A, I don't think we should really, I don't think we have to really, I don't think we have much here. So anyways, so example 4, you would like to have extra spending money, so you decide to work part-time at the local gym. The job pays $15 per hour, and you work 200 hours, 20 hours per week. Your employer withholds 10% of your gross pay for federal taxes, and 7.65% for FICA taxes, and 3% for state taxes. For A, what is your weekly gross pay? So my gross pay is what I have before anything is taken out, right? Well, $15 per hour, and I work 20 hours per week. Well, 15 times 10 is 150, and then times 20 is 300. So my gross pay is $300. Whoopee, I have $300. Not so fast. How much is withheld per week? Okay, so it says the employer withholds 10% of your gross pay for federal taxes. So 10% of $300 is $30. Okay, so I mean, I'm okay with that. I can live with that right now. How much is withheld per week with FICA taxes? Well, FICA taxes is 7.65%. Well, I can't do that one in my head. So 300 times 0.0765, and that's $22.95. Okay. Okay, that's not so bad. I mean, I'm helping out. I'm helping people out. Not only that, but I'm helping myself out because when I get old, I'm gonna need some Social Security, right? D, how much is withheld per week for state taxes? Okay, so 3%. Well, 1% is $3, 3% is $9, so $9. Okay. Okay. Again, I mean, I like the roads I'm driving on, so I guess I can deal with that, no problem. Well, what is my weekly net pay? Okay, so my weekly net pay is going to be $300. That's my gross, and I'm subtracting 30 for the income tax, $22.95 for FICA, and $9 for state taxes. So that means that my paycheck is now a measly $238.05. It's as if I worked 14 hours, right? But I really worked 20. But I mean, again, I mean, it's taxes. Taxes, you have to pay them, right? I mean, there's only two things in life that you can expect, and that's death and taxes. Anyways, so what percentage of your gross pay is withheld for taxes? So the percentage is going to be how much I make over my gross pay. So $238.05. Let's actually write that out. So 238, $238.05 divided by 300. Okay, so probably should have done 1 minus that. But, well, huh. Actually, there's a couple ways to go about this. So I would typically do 1 minus that because it's 100% minus the percentage I pay for taxes. So let's do that over. Let's just rewrite that rather. Okay. So 1 minus however much I pay in taxes. So again, that was 238.05 divided by 300, and that is equal to 20.65. This is round to the nearest 10%, so 0.2. Well, it wants percentages, right? So that's not an equal sign because it's not necessarily equal to it. We're just going to put an arrow sign because that's what it means, and it's 20.7%. Okay, so my little part-time job, I'm only getting 20, or I'm paying 20% of my paycheck to taxes. So I'm taking home less than 80% of my income, right? And it gets so much worse whenever you do start having jobs with, uh, well, I say I mean, benefits are nice and they're called benefits for a reason. But I think my paycheck, I take home something like 67% of my paycheck. And on top of that, here in where I live in Hendersonville, uh, it is that I also pay 10% tax on everything I buy. So man, we just get taxed like crazy. But again, you just got to think of it. Well, I've got nice roads to drive on. Hopefully, when I get older, I can have my Social Security as well. So that you have to look at it in different lights. But anyways, that concludes my soapbox moment, and that also concludes my lecture.